Oh, no. Hey, everybody. Welcome. Getting set up for our Money in the Morning. I just deleted something that not good. You know, when you delete something, you go, "Oh, I'm not going to need that," and then you just get that done, and you go, "I totally needed that." So this will be a good time. Good morning, Karen. I got your message, and no, we did not go to Florida, but I'll write you back. I got in really late last night from Zion National Park. And so we're trying to get the let out today. Already recorded I'm going to be a guest on Martinis and Your Money with Shannon McClay. Good podcast. And so we recorded one of those today. And because I've been out of town, we haven't written Doug's part of Wednesday's show. We recorded most of it, but we haven't written it yet. All right. And this stuff here is going to be great. Of course, I always say that about our headlines, don't I? Okay. I know, Lori. Yeah. You heard me deleting something that I shouldn't have deleted. And actually what it is, it's who won these games. Like, I'm like, oh, I don't need this list of who won these books and games. Because it wasn't that, it was just the list of cities. And I forgot that I had people's names written next to it. And I was going to come back to that and use that as my platform of who got what. I kind of remember who got what, though. Isn't that weird? That was what, last Thursday? All right, one more time. Okay, we're good. All right, guys. This is going to be for, unless some big news comes up, this will be Wednesday's show. Here we go. Live from Bob's Finished Basement. It's Money in the Morning. I'm Joe Saul-Sehy, Average Joe Money on Twitter, and we have two headlines each day. We not only have that, we then tie the two headlines together so that you can make better money decisions or just go about your day knowing what some of the important financial things are out there in the money universe. Today, we've got two big ones. Netflix just announced a couple days ago, they're selling $105 billion of bonds. Specific type of bond, though, a junk bond. So we're going to talk junk bonds. And then in our second headline, the Treasury yield creeping up to 3%. What does that mean? It's bond day here at Money in the Morning, and that's going to be our theme all day long. I had a fun few days out of the basement recently, and I took with me a bunch of our Stacking Benjamin shirts, and it's always fun to see people look at the shirt, like, what the heck, Stacking Benjamins, we got a long way to go in our quest to take over the world. But if you would like to take over your little part of the world, here's what you do. Head to stackingbenjamins.com/shirts. And you too can wear some fantastic Stacking Benjamins gear designed by our friends at Flying Pork Apparel, Brad Larkin Company. That guy's an amazing designer and just fits our mood completely. StackingBenjamins.com/shirts. All right, you got stuff to do this morning. We got headlines, so let's get this party started.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamins headlines.
Big news from Bloomberg. This out of Netflix. Netflix is tapping junk bond buyers again to help it fund its next wave of shows. The world's largest online television network selling $1.5 billion of senior bonds, according to a statement Monday. The 10.5-year notes are expected to price soon, according to a person with knowledge of the matter who asked not to be identified as the details are private. I love it. I'll tell you what's going on, but I'm not going to give you the details. Netflix sale plan follows a quarter in which it added 7.41 million subscribers, its strongest start to a year since going public 16 years ago. Moody's Investor Service upgraded the company earlier this month, citing expectations as the growth will continue and eventually turn its cash flows positive. How great is that? 16 years in business and you're still looking for cash flow positive. The upgrade may give Netflix the support to sell $2 billion of bonds to boost liquidity and pay for rising programming costs, Bloomberg intelligence analyst Stephen Flynn said in a recent report. The proceeds of the offering will be used for general corporate purposes, which may include content acquisitions, production, and development, as well as potential acquisitions. So here's the thing. We've got Netflix out selling some debt. That seems exciting, doesn't it? Netflix selling debt. And when I think about this initially, it reminds me of a cautionary tale. And this cautionary tale involves the word junk, because Netflix bonds are considered junk bonds. Now, for those people that have been investing for a long, long time, they're going to say junk bonds, pretty scary thing, junk bonds. I remember junk bonds, a lot of people going to jail, and the answer would be correct. However, those were people playing in the junk bond market that had nothing to do with the underlying bonds themselves. But that said, people that don't know bonds, let's talk about what junk bonds are. So you and I, when we go out and we try to get a loan, what do they look at? They look at our credit rating, right? And it's the same thing if you're somebody who owns a business and you're trying to, like they said, build new shows out, general things that Netflix is trying to do to increase the size of the company, right? And make their operation work better. They go into debt to do that. Well, they have a credit rating too, but it's called their bond rating. And their bond rating, because bonds are loans, their bond rating is these analysts, like your FICO score, with you personally, a bond rating is your likelihood this company's going to repay the debt. Netflix is considered junk. Now, I watch a lot of movies, watch a fair amount of TV, spend a good amount of time on Netflix, really liking Chef's Table right now, by the way. Good stuff if you like documentaries about food. Not good for that late night eating you shouldn't do, by the way. Not good for that. Makes me crave food because I'm generally watching at night. But besides that, good programming. And Netflix is known for good programming of their own. And more, it's original programming, right, that they're doing. And they need to fund that. So they take out loans to do it. And that's considered junk bonds. Junk bonds are the lowest rated bonds, which means rating companies think they're going to have some difficulty paying these loans off, which also means if you loan Netflix money, you're probably going to get a high interest rate for that, right? Because think about this. If you've got a low credit score, what happens? You might get a credit card, but if you get a credit card, it's going to be at a very, very high interest rate because they don't think you're going to repay. You get lower interest rates as your credit gets better. So when I hear Netflix junk bonds, I think, oh man, this could be a high interest rate opportunity. Now, there's some people listening to this who might be thinking to themselves, well, Netflix, you just said, Joe, they had a great quarter and it's Netflix. I mean, come on. What could be easier? This just looks like free money. You have to watch out for, and this is our big takeaway and number one here, don't let your bias cloud your investment decisions, because a lot of people think, oh, Netflix, what could go wrong? Clearly this is mispriced. No, there are people with a lot more information than you and I, which establish these ratings, and they create these ratings to protect you. And you want to watch out for, well, it's Netflix. Can't have that. It's okay to have that reaction. And then it's okay to go, there's something I might not know, right? There might be some details that I need more help with. So I did this, by the way. During the market downturn, just before I stopped being a financial planner at age 40, I saw General Motors bonds that were way on sale, completely way on sale. And I thought, it's General Motors. They're not going to go under. There's no way that the government would let him go. I mean, this is one of the biggest car companies in the United States. The government clearly will not let them go under. And so I, because of my bias, I showed people these bonds, clients of mine. And by the way, they were in Detroit also, like I was. So here's a Detroit-based company, me, a guy whose dad worked for General Motors his entire career. I think GM, look at the interest rate on these bonds. I mean, we were getting these huge interest rates because the bonds were big time on sale. And by the way, as you know, the end of this story, General Motors bonds on sale for a very, very good reason. That was a forest fire. It was a horrible place to be. And yet, because I was in Detroit, because my dad worked for GM, I thought this was just an opportunity, right? And so we got in, and luckily, I was able to get people out. And how did we do that? We went from one forest fire to a different forest fire without getting into it, a forest fire that we were more likely to get out of. And so jump ship to a different type of bond, rode those back up after it got very, very, very scary. And of course, a lot of people lost a ton of money investing in General Motors. So we want to watch out for bias. We bring our own biases to every investment. And it's okay to have a bias. I mean, there's no way around it, right? You're going to have a bias. But what is that bias? Mine was, can't happen when it comes to Netflix here. Netflix is selling debt. Sounds cool, but it's junk status. Might be an opportunity, but realize the risk that you're taking. Netflix paying those loans off over 10 and a half years. Think about how much the landscape's changed over the last 10 and a half years, right? Netflix has been public for 16 years, and think about the amount of changes they've already had. I mean, discs, right? Who still gets Netflix discs in the mail? Maybe you do, but you're in the minority. Most people just stream Netflix. And Netflix 16 years ago, no original programming. They were competing against Blockbuster, right? Where's Blockbuster today? So big changes in the next 10 and a half years, and people think it's worth a high interest rate for you to, if you're going to invest in it, means it's a shakier investment decision than you think. So that's Junk Bonds 101, kids. And let's say hello to our friends hanging out with us on Facebook before we head to round two. We do these live without a net on Facebook. So if you're hanging out at facebook.com/iStackBenjamins, you'll get a little alert that says, hey, we're recording this thing live. And say a big hello to Karen, to Lori, and to Jorge. Nice to see all of you today. All right, let's move on to our second headline, which comes to us in the Wall Street Journal. And this one is also about bonds. This piece written by Riva Gold, Joanne Chow, and Mike Bird. Treasury yield nears 3%, stocks edge up. Treasury yield nears 3%, dollar strengthens. U.S. stocks early this week rose as the 10-year Treasury yield came within striking distance of 3%. Yields were last at 2.971, according to TradeWeb, after settling at 2.949 late Friday in New York, highest afternoon level since January 2014. Yields move inversely to prices. I want to stop right there because apparently I'm all excited about bonds today because we have two headlines about bonds. Yields move inversely to prices. What does that mean? A lot of people think that as the stock market goes up, bond prices go down. Stocks and bonds, whole different story there. It's actually bond prices and bond yields, the interest that you're going to get on the bond. So as the interest rate goes up, the prices of bonds you hold on to go down. And so that's they call it the teeter-totter. Yields higher, prices lower. So yields are going up, bond prices then are falling. If you hold on to bonds now, you probably have a lower price than you had before. The cool thing is that as you continue to get that yield, as you continue to get the dividend, some pay quarterly, some pay twice a year, some pay annually. As you get those dividends, those make up for the fact that the price has lowered. And if you own individual bonds, you can hold those bonds until they pay off, right? Those Netflix bonds, we were talking about 10 and a half years, they'll pay off. You hold that maybe for 10 and a half years, they'll pay you dividend along the way. I don't know according to what schedule yet, but they'll pay you dividend along the way. And at the end, you'll get paid. By the way, there's a type of bond called a zero coupon bond. And the coupon is that interest rate you're going to get. So one thing you can say, if you want to look clever around people that know bonds, say, how often do I get my coupon? How often does that coupon pay? And they'll tell you, oh, it's quarterly, or it's a zero coupon. If it's a zero coupon, they're paying it all at the end. That's what that means. But anyway, usually you're going to get paid along the way. And if you reinvest that into the bond, you can also then buy these shares while they're lower and make up for the fact over time that the bond prices went down. But regardless, let's go into this a little bit more. It says stocks appear to show only a limited reaction to the move. So yields higher on treasuries. Now, what makes those yields go higher on treasuries, and why wouldn't stocks react? Stocks and bonds react separately. If interest rates go too high, though, remember stocks are ownership of companies. Interest rates go too high, it becomes harder for companies to make money if they have debt and they got to pay their bills. And if they're paying their bills at a high interest rate, like Netflix is, then less money gets to go toward operations. I mean, think about this. In lots of markets, mortgage rates, 6-7%, right? Lately, though, we've had some people have interest rates in the 2s on their mortgage. If you're paying a 2-point-something% on your mortgage, think about how great that is for the rest of your life. You're not paying hardly anything for your house interest, and now you can spend that money on other stuff. Same thing if you're a business. If you're a business, you have very low interest rates. It's very easy to then spend money on your business. So the frustrating thing for stocks is as interest rates go up, people that buy stocks go, oh man, going to be hard for businesses. They're going to start to struggle. So you will see higher interest rates kind of slow down the stock market over time. Says in this piece that hasn't been the case here lately. Treasuries themselves. Now we talked earlier about junk bonds. Let's go to the other side of the fence, which is treasuries, where junk bonds are the most aggressive bonds. Treasuries are the least aggressive. Treasuries are the baseline when it comes to a lot of bond pricing because treasuries are sold at auction. And the way the auction works is the opposite of an auction on a car. And actually people will, you're basically bidding on the interest rate. Let's say that they start at 3%. And imagine a room full of people and they're saying, hey, $100 for this treasury bill. Who will take it at 3? Who will take it at 3%? And obviously a lot of people want 3. But then they say, well, what about 2.9? Bunch of people still leave their hand up. Those people are still going to win. How about 2.8? How about 2.7? And instead of, the person that will buy it for the highest price, they're looking for the person that will loan them money for the lowest interest rate. I mean, if you're the federal government, it makes sense, right? I want to, because a treasury is a U.S. treasury. So you're loaning money to the United States government if you buy treasury bills. The government's saying, hey, we'll sell this at an auction to the person that will take our debt for the least amount of interest that we have to pay. So now you're seeing all those hands go down just below 3%. People, I think I want 3% on my money, and I'm not going to do less than that. So that's a little. It's not exactly how it works, but for you and I, thinking about the way that auction works that way, I think in your head makes a lot of sense and kind of clears up some of the confusion about how these bond prices work. I think that the big point is the treasury yield goes up to 3. What does that mean? You might be saying to yourself as you're listening to this, you're like, none of this affects me, Joe. Bond prices doesn't affect me. Oh, it does. We talked about the stock market, but that's not it. If you have credit card debt or an auto loan, those things actually follow different rates, which we'll get into in another show, but very close to what's going on in the treasury market. Very close. And if you own a mortgage or you're thinking about moving, right? Treasury bills, the long-term mortgages are based on the T-bill, as treasuries are called. So as we see interest rates go up there, thinking about moving, you might want to lock in that mortgage sooner rather than later, because they're talking about both this and the Fed funds rate, which is the other rate I said I wasn't going to get into. Those two rates, which don't move exactly in lockstep, but as those go higher, you're going to see your debt get interest rates on your debt go bigger. So anytime that you have adjustable rate debt where it can move between the Fed funds rate and if you have a mortgage, the T-bill rate, those two really do affect you. So if you have debt, if you're in the stock market, no matter where you are, bond prices do affect you. And unfortunately, that means you should probably pay a little bit of attention to what's going on in the bond market. So that is our big takeaway from number 2, how bond prices affect you. We're going to now take these two in just a second, these two headlines, and we're going to meld them together. How are we going to do that? I'll tell you in just a minute. But first, pick up some Stacky Benjamin swag at stackybenjamins.com/shirts. You'll see all of our swag. We are working on right now. I love what Paula Pant has done, which is her little tiny sliver of profit goes to a charity. We're going to be doing the same thing. Haven't chosen the charity. I need to do that very soon. But regardless, if you want to wear some funny swag about a funny podcast, stackybenjamins.com/shirts. All right. Let's meld these two together. We started off with Netflix selling debt that is junk bonds. And then we talked about the Treasury bill nearing 3%. If we take these bonds, what does that mean to you? What's the big idea? Bonds have ratings and companies have ratings. Here's my question for today, guys. What's your rating? What's your bond rating? If you were to think about yourself as a company, would you be more like a Treasury where people really want to hand you money? Or are you closer to a junk bond? And if you think about that like a company, doesn't it kind of change everything? Because when you look at your own situation from the outside looking in, all of a sudden you make different decisions than you were making before. You're now making these decisions based on an investor, right? Like you are otherwise. So what's the reason? What is the reason why your bond rating is where it is? Is it because you haven't paid your debt off in full? Is it because of the fact that your earning potential long-term isn't what it should be? Is it because of the fact that you haven't been working on that side hustle? You know what the reason is that your bond rating could be higher. And that I think is the rest of that story, right? What is your bond rating? How do you make it higher? That's your exercise for today. Thanks a lot for hanging out, everybody. That's going to be it for Money in the Morning today. We'll see you next time here. Go stack some Benjamins. Bye-bye.
Money in the Morning is created by Joe Saul-Sehy and is brought to our channels by our producer and engineer, Richie Rutter-Reese. Stacking Benjamins and Money in the Morning are for entertainment purposes. Before making moves, consult with your financial advisor. Looking for training sessions? Kathleen Selmans has a great suite of Stacking Benjamins tools, so head on over to learn.stackingbenjamins.com. Hoping to chat with us on the web? Say hello to Shannon Cowan, our social media guru and community manager in our Facebook group. She can be found at stackingbenjamins.com/basement. From the basement, I'm Joe's mom's neighbor, Doug. See you tomorrow.
All right. Man, I felt a little rusty on that one. But that was fun. I love being able to go over bonds. I love how, even though OG's not a big fan of bonds, I love talking about how they work because it does affect our life so much. And it's funny because it seems, I don't know, it seemed like it would have been hard when I first learned how bonds work. And of course, everybody teaches you bonds in this way that's super analytical. And I didn't get it until you start comparing it to your own life. And when somebody talked to me about credit rating versus bond rating, then like the light bulb came on. Like, oh, now I get it. Now I know where we're headed. So I get to figure out who gets all this lovely stuff. Big announcement coming up in the stacker this week. Big announcement. Well, I think it's big. You may not think it's that big, but big stuff for us. I don't know if I made it make sense, Lori, but hopefully we cleared the cobwebs a little bit. I was going to, I went to Zion National Park the last few days. Friends of ours ran one of my friends ran 100-mile race, and others ran a 50K, 31 miles. And Cheryl and I just hiked. So it was a fun hike. There's this place called Angel's Landing, and 12 people have died apparently so far this year hiking Angel's Landing. And it's because you are walking in these places, hanging on to this chain while there's 1,500-foot drops on either side of you. Or if you're climbing up like the side of this cliff, behind you, and that freaks you out just slightly. And it's a little crowded, headed up to Angel's Landing. So there's times when there's people that are also afraid, and you kind of they're coming down, you're going up, and you got to kind of swing around them, and there's no room to do that. It's a little pressure. I only had one part where I thought I was going to die. I went to grab the line, and I wasn't looking. I had my eyes up looking at the next thing, and a woman behind me had grabbed the chain, and it had moved. And I went and grabbed with my arm, and I missed, and I lost my footing for just a second and started to go backward, and grabbed it at the last second, like grabbed the chain and pulled myself back in. But so that was was a little thrilling. Thrilling is a good word. That was at the top. You actually go up to this place called Scouts Landing, where you have a good view there. You've got a great view. You're probably you're not that much lower than Angel's Landing, and that walk up to Scouts Landing is pretty easy. Strenuous because it's high, but it's all paved trail. It's after that from Scouts Landing to Angel's Landing that's hell. Almost like if you've ever done Half Dome. Half Dome is really is an easy hike until you get to the very, very top, and then you're on a chain again with a group of people, and if you let go, you're dead. I actually thought Half Dome was scarier if you've ever hiked Half Dome. Rusty, 26.2, man. Nice. So I've done 11 marathons, but I haven't, I got to get back into deciding what my next marathon is. And I don't know which one I'm going to do. I almost did the Dopey this year at Disney and then canceled it. Actually was able to cancel my registration for Disney. And they had to find somebody else to take it, which was easy because everybody wants to do that one. But the Dopey's where you do the 5K, the 10K, the half, and the full. And it's really fun. I mean, you just go slow, right? And there's all the characters around the way. Speaking of that, Julian, Netflix makes me think of Disney before Disneyland. No idea. Yeah, that's interesting. I hadn't thought about that comparison. Netflix, though, making some good quality content and lots of it. The bad news is we're in this golden age of TV. I agree with something I read the other day, which is there's too much good TV. I mean, you can't watch it all. And there's so much quality programming out there. I think about that with podcasts too, actually, sadly. I can't consume all the great podcasts that I like. There's too much stuff. So I really have to pick and choose. I was listening to 99% Invisible the other day, one of my favorite podcasts, and realized I haven't listened to 99% Invisible in almost a month and a half. So good one about hairstyles, which is, I love how they come up with these ideas. It was only one time I thought that's a great way to explain your weekend. Yeah, only one time, Lori. I thought I was going to die this weekend. It was fantastic. Besides that, Missoula, Montana. Oh, I bet that would be beautiful. You know, we did the last marathon I did was by Acadia National Park in Maine. And it was such a beautiful marathon. Runner's World calls it the most beautiful marathon in the country. And I haven't done all the marathons, but man, was it pretty. It was such a pretty marathon. It was brutal. It was up and down, but man, it was so pretty. You're 90 miles north of Dallas. Yeah, about when we're in Dallas, Rusty, have to. So we're probably probably 4 hours apart. So good stuff. Well, good luck, Rusty, with your marathon. It's run a marathon's no joke. This hike that we did, this hiking that we did was my legs are just all ripped up just from hiking. Feels kind of pathetic. But the day before we did Angel's Landing, we did another hike called the Narrows. And if you look up Zion National Park, the Narrows, you're hiking a river, and it's really neat. The river's cut down through this stone, and you have a stick, you have some waders, and you're hiking up the river. And that was beautiful. It was Zion National Park is amazing. It's the first park I've been to where both of my kids went before me. My son went when he did his charity bicycle ride from Austin to Anchorage. He went first, and then my daughter went. She was working in Arizona, and just friends of hers decided together to fly into St. George and go to Zion National Park together. And so we decided we had to go too. Had to stop in Vegas on the way home. And because that's where we're flying out of, but went early and had to play craps again. And man, I've been gambling a lot lately. Like I haven't gambled forever, ever. And I won $50. So I'm feeling pretty proud. So that paid for our lunch. All right, guys, I'm going to on to the next thing. Have to write Doug stuff for Wednesday show. And I have to get out the stacker this week, which is a big fun announcement from us. We're taking on some big thing, and it's going to be fun. All right. See you later. Good luck with your marathon, Rusty.